Do you want to know how to protect yourself in this market? Do you want to know about the greatest financial risks? Do you want to understand the lumber to gold ratio? I have interviewed Michael Gayed from the Lead Lag Report, and today he's going to get into all that and more. Let's begin. I want to thank Michael for being on today. For those who aren't aware of who you are, if you don't mind just giving a 30-second rundown, please.
Yeah, no, appreciate it. So I'm there's kind of two main things that I do. One is I'm the publisher of the Lead Lag Report, which is this premium research service I put out there. And I always say that the objective around that research is to focus on the idea that if you want to kill it in the stock market, you have to not get killed. So it's much more centered around risk management more so than anything else. And then the second thing that I do, which is pretty big, is that I'm a portfolio manager of two funds: the ATAC Rotation Mutual Fund, as well as the Risk On, Risk Off RORO ETF. So I'm basically applying a lot of the concepts that I put out on social media as a fiduciary running public money.
Excellent. Thank you very much. So, what I really wanted to start with was something that we've been talking about here on this channel for a little while. And it starts with lumber because you saw the price of lumber going up like crazy. It hit 1700, is now down to what is it, 900 or so. So it's certainly come down quite a bit. And in my research, I found one of your reports. I brought that in the channel, did a video about it. That's how you contacted me, and now we're here. So one of the most important aspects of that video, and of course some of the work that you've been doing for a long time, not just right now, is the lumber to gold ratio. And I want to ask you, if you wouldn't mind, to make it clear, what does that ratio tell us, and what does it not tell us?
So it's funny in the Lead Lag Report and on my Twitter feed, on my pinned tweet on at Lead Lag Report, I put out a series of charts that basically show that historically, when lumber relative to gold is weak, that tends to precede major crashes, corrections, and bear markets. And a lot of people ended up saying, well, this is a classic example of correlation and not causation. Meanwhile, they're tweeting that from their home, which has about 16,000 board feet of lumber. Right. So let's talk about that. So in 2015, I won the Founders Award for a white paper titled Lumber Worth Its Weight in Gold. And that is one of the 5 different papers I'm known for that I've published since 2014. It's always the one that got the most curiosity because it's a strange concept. Why would lumber and gold tell you anything at all about the stock market? And the link is exactly that. It's around housing, right? So we know that economically, housing is a leading indicator of the economy. Most people's wealth is in their homes. Whenever the Fed wants to talk about the wealth effect, they're really talking more about homes than stocks because of this distribution of assets, of money that's put in assets, mostly in the house. And again, most homes have about 16,000 board feet of lumber. So it stands to reason that if housing is a leading indicator, then lumber, by extension, must be as well. And there's a lot of other studies that show that lumber correlates very strongly to housing starts, which makes sense because of how much of a key component it is. Now, that makes it, I would argue, one of the most cyclical commodities. A lot of people talk about copper, which is also cyclical, but I think lumber is actually a stronger tell from that standpoint. Gold, on the other hand, is more of a safe haven commodity, meaning that for the most part, historically, when you have these risk off high volatility periods in the stock market, gold for a moment in time tends to do fairly well. Again, not my opinion. This is quantitatively how it plays out. So if you compare lumber to gold, it actually tells you a lot about risk, right? And one of the key findings in that paper, which is really critical to an understanding of what risk on, risk off ultimately is about, is that when lumber is outperforming gold over a rolling 13-week period, but can be other time frames, of course, as well, generally stock market volatility tends to be low. If gold is outperforming lumber, you tend to have much higher stock market volatility on a go-forward basis. That matters because it's in those higher volatility states when you tend to have the major accidents, the major crashes, corrections, and bear markets. Now, I think what people may be misinterpreting about that relationship is that because it's been getting around on MarketWatch and kudos to you for also spotlighting it. I think people are forgetting that just because you have lumber to gold weak doesn't mean you're guaranteed to have a crash. It's that when you have a crash, correction, or bear market, lumber to gold tends to already be weak. And that's an important distinction. That's why I always like to frame, market dynamics in terms of conditions. I don't know the mile marker. I might crash my car, but I know the conditions that favor an accident. You only know the mile marker or if that's the storm where the accident happens with hindsight. But you've got to slow down when it's raining. And at least for now, lumber to gold, to your point, did collapse, right? Since really around the second week of May is when it started breaking down. And that's not just a function of sawmills coming online. There's other intermarket relationships here, which are confirming the message of lumber, which is that we may actually be seeing a slowdown coming soon.
So one of the things that you've talked about, and really I want you to highlight, is risk on, risk off. If you wouldn't mind talking about that concept and just how that applies to what you do.
Yeah, no, and I appreciate that question because I think it's nuanced. Personally, I cannot stand it when the media says, well, it's a risk on day because stocks are positive. Ah, it's a risk off day because stocks are negative. That's not what risk on, risk off is about. Risk on, risk off is ultimately about conditions that favor changing volatility in equities. Risk on, lower average volatility likelihood. Risk off, higher average volatility likelihood. Again, not guaranteed. There are plenty of down days where on Twitter I will outright say this is a risk on day. And people kind of shake their heads. Why am I saying it's a risk on day? Because if you have a down day and small caps are outperforming and cyclical sectors are outperforming and treasury yields are rising, that's all behavior consistent with reflationary pricing internally in the market, which is exactly what you'd want to see in a risk on type of environment, right? So for me, risk on, risk off is ultimately about conditions that favor changing volatility regimes. It matters because the tail risks tend to live again in the risk off conditions, the higher volatility likelihood scenarios. It's funny, as you know, right, from a lot of studies on behavioral finance, people gravitate towards consistency. They all want the thing which is going up gradually, month after month, year after year, which kind of harkens back to the Nassim Taleb turkey problem. Right? The turkey thinks every single day that the butcher is its friend because it's getting fed every single day until one day, right, when it's the end of the turkey's life. And markets have that dynamic, right, where very quickly they can aggressively collapse. There's a tail that wags, and even though those tails, when they wag, are relatively infrequent, they still matter because it can define a generation of performance, right? And that's sort of where my obsession really tends to live, not just in the lead lag report, but also I do this in the risk on, risk off RORO ETF, going all in equities, all in treasuries.
So one of the things that I talk about on the channel all the time is, where are the biggest risks, where there is fragility, where we have too much excess and so on. And I wanted to ask you where you think the biggest risk is today. If you look at certain elements of the stock market, or maybe this is in the banking sector, or anything that you could share around where we see the biggest risks, and maybe if you wouldn't mind, where the least risk is right now.
Yeah, so it's funny because my expression of risk off in the RORO ETF and everything I address in lead lag is treasuries. But just because that's a risk off, quote unquote, safe haven doesn't mean there isn't risk, right? That's an important distinction. Now, what I would say is that I think all risks are couched under one thing and one thing only, which is leverage. The sheer amount of debt there is in the system. I know you've talked about that correctly so to a lot of your audience. So, and it's leverage everywhere, right? It's leverage in terms of government debt. It's leverage in terms of the uneducated speculation going on in the stock market. You can see that with margin debt. You can see that with even short interest being as low as it is, meaning everyone's levered long, and kind of one-sided. And I think even talk about fragility. So it's funny because I'm halfway through again re-listening to Nassim Taleb's book Anti-Fragile, right? And Taleb is known for the black swan way of thinking about markets. Small events having very significant impacts, which is sort of symptomatic of chaos theory and the stock market and things like that. And one of the things that Taleb correctly points out is that black swans tend to appear when leverage is very high, right? Because of that consistency. Meaning, if you have believed that the markets are going to keep going up gradually every single month, every single year, it emboldens investors to take on more risk because they think it's a guarantee. And then at some point, there's an inflection where the leverage is too much. And that's when you get the tail event, the black swan, the major collapse, right? At least for a moment in time in the sequence of returns. So the biggest risk is that I think everyone is skating on thin ice here with the sheer amount of debt there is in the system. And when you have this much debt in the system enabled by the Federal Reserve and politicians, it doesn't take that many butterflies flapping their wings to create a hurricane. And I think it's a massively, massively underappreciated fact with everybody that's just saying stocks for the long run. Yeah, okay, stocks for the long run assume that debt was not for the long run as well.
Great points. You know, as you look towards commodities right now today, obviously they've had a massive, massive run up. Things like lumber have come down considerably. Other things are still extremely high. You see that there are shortages. You see that there are droughts happening in the United States and so on. Where do you see commodities, in the next little while? If you could give some sort of time frame around that in terms of, are they still in the run up? I don't know if it was a Goldman Sachs that said this is the commodities super cycle that's has just begun, and we sort of bottomed out last year, and this is like the run up. If you wouldn't mind sharing a little bit about that.
Yeah, so look, I think that commodities probably are in some kind of a secular cycle. I don't know if it's a super cycle, although if you do have gangbusters infrastructure spending globally, then you can make a case that that's going to cause persistent bid in a lot of these commodity and raw materials. The and when you look at a lot of metrics like equity to commodity ratios, right? I mean, equities have so substantially outperformed commodities that you can make a case that there's a mean reversion between the two asset classes. Now, of course, not all commodities are created equal, right? Because some are more dependent upon demand and some more are more dependent upon shocks, right? So, for example, in the food space, that's very prone to shocks based on weather patterns, right? So you've seen corn and soybeans go vertically. A lot of that obviously is due to COVID and supply disruptions, but also there have been some weather patterns which have made it hard for the supply to sort of keep up with the demand, especially coming out of China. So but also at the same time, some of these commodities end up being sort of mean reverting in terms of getting to their cost of production. So you have these kind of junctures where food and ag commodities run, and then they come right back down because governments subsidize the cost because you got to make sure the society is fed, right? So there are these kind of sub pockets you kind of think about when it comes to commodities. But yes, I do think that there's a secular case for commodities to keep running. But having said that, all that means is that there are going to be more boom and bust cycles, right? Because commodities are a form of cost push inflationary pressure. So if you have commodities running, that would force inflation expectations higher. But if the commodities run too hot, which I think is what happened with lumber and a lot of other areas like copper too, it actually becomes a self-correcting disinflationary force because people say, well, you know what, I'm going to hold off on replacing my wood fence. Right. So you're going to have this kind of broader secular move, but you're going to have these kind of waves within that. And I think that's sort of important just to keep in mind from an expectation standpoint.
Well, that really brings me into my next question, and this the hot debate out there, and that is inflation versus deflation. There's, I would say, the general financial community is saying inflation is here. If you look at the Bank of America Fund Manager Survey, they suggest that it's all transitory, it's temporary. Then you had the Federal Reserve actually admitting that we did expect it to run a little hot, but this is even hotter than we expected. And Bullard had said, maybe we're going to start talking about this increase of interest rates in 2022 versus 2023. And as they were saying just a week ago, they were saying 2024 would be kind of the first rate hike. You look at other central banks around the world, I believe there's already 19 rate hikes in 2021 alone. So things are certainly changing, but I wanted to know what you think about the inflation versus deflation debate.
So a couple things. I don't know why anybody cares about what the Fed thinks about the future because just like everybody else, nobody can predict it. I remember very well, maybe like 15, 20 years ago, I saw a headline where the Fed was basically doing sort of self-assessment. How accurate are their historical forecasts? And even the Federal Reserve itself in that study said they are no better than anybody else, right? And it always goes back to nobody can predict the future. The best I can tell you about is the weather. It's funny, on a side note, I get people that sometimes say, oh, it seems like you're not taking a stand, not making a call. Of all the industries, of all the professions that deal with the business of forecasting, the profession where people have the most accuracy in their domain are weathermen, which is funny because people seem to hate weathermen, but they are the best at predicting the future in their domain, right? So that's more of a side note. So let's talk about this inflation deflation debate. Okay, I tend to personally be much more on the deflationist camp longer term. Okay, and I'm saying that because you've got demographics which are completely against you, right? Old aging population, not just in the U.S., globally, it's a phenomenon across the board. You have the wealth gap, okay, which is only getting wider, largely, I would argue, because of Federal Reserve policies. Zuckerberg does not need two planes. You can't really get the velocity of money to pick up if you don't have that many people having that much money to spend. And then, of course, the other one is technology. All right, technology is massively disinflationary. So those are secular trends, and that's why when you look at things like the velocity of money, because inflation is a function of money supply, but also the transactions that occur. That's why velocity of money has just been, in a crash almost like continuously. Now, having said that, whenever somebody says, "Do you believe in inflation or deflation?" my answer is always yes. It's both. Because what's the response by the Federal Reserve to shocks? It's to lower interest rates, to expand the balance sheet, to print more money. Okay, that creates short-term inflationary pressure. We're seeing that. But the more you have debt in the system, the more disinflationary and deflationary that is, because you can't increase rates because the interest expense ends up swamping sort of the amount of revenue you get on the government side from a tax perspective. So it's very hard, I think, to really have sort of any kind of persistence inflation in the absence of literally giving checks to people every single month for the rest of their lives. And that's a dynamic I think that's important for most people to consider when they think about this inflation deflation question.
Okay. So, one of the things that I talk about here on the channel, of course, my favorite topic is the Federal Reserve. And the Federal Reserve, every time they make a statement, an announcement, a change, they're always going towards, looking at trying to, make their words essentially very soft, and they're very calculated, and they're always doing these things. We just had the Fed meeting, and the whole market has really been relying on the Federal Reserve to print a lot of money, the Federal Reserve to keep interest rates low. Where do you see sort of the impact that the Fed has on the market for the foreseeable future, considering that they've started to talking about actually increasing rates and the tapering their money printing and so on? How much of an impact do you think that will have?
Well, I mean, just very recently we saw that, this after the Fed announcement, right? You saw the reverse repos, them draining some liquidity, and the market took a bit of a hit on that, right? So they don't have to necessarily raise rates; they can do it in other ways, right? They can conceivably do it by talking up the dollar, right? Because there's a lot of ways to kind of slow down the economy, right, and slow down inflation beyond just interest rates. Now, the thing is about this, all these dot plots, again, I kind of shake my head on forecasts with this stuff, right? So they're saying, I think, what, 2023 or 2024 is when the first rate hike would be. I mean, I want to see their models in 2018 if they thought there was going to be a pandemic 2 years after. And I'm talking about 2 years from the next hike now. The issue here is, again, I go back to, with this much debt in the system, any number of butterflies can create a hurricane. Well, when you have this much leverage, it means that you probably don't have that much time between the pandemic and another black swan happening, which means another response to do more stimulus, to do more money printing. So my point is that when you have this much debt, these kind of 1 in 1,000 year events happen much more frequently and much shorter in time frame next to each other. So I don't think at all the Fed is going to raise rates. And even if they do, it'll also cause a lowering of rates, which, by the way, is what we're seeing, meaning you have these expectations that they raise the short end, but what's happening at the long end of the curve, long duration treasuries, at least last week, the yields dropped quite a bit. Right, there's a rally, so you have this kind of flattening where the short end is maybe bumping up on yield, but the long end is saying we're not buying it. And this is why I think the Fed is unequivocally stuck. All right, they're stuck because they created the debt monster. The debt monster is not going to allow them to get higher inflation, and at the same time, it keeps on creating this self-reinforcement cycle of stimulus, wealth effect widening because stimulus disproportionately affects asset holders, which are the very wealthy, and the cycle just keeps repeating until something breaks. Right. And, we were talking about this before the show here. I don't choose the conditions, right? I don't choose the cards I'm dealt. I just choose to play the game, right? Nobody knows if there is going to be a so-called great reset, as historically has been the case. But I can see where the sentiment comes from when you see some of these longer term dynamics.
That brings me to my next point here. So, given everything we've talked about today, given everything that's been going on, in terms of investment strategies, you have a lot of people that are perhaps newer to the game, or perhaps have been let's say, moderately successful with their 401k and where they've been putting their money. And you look at a lot of people that just simply say, I invest in good companies, therefore meaning FANG stocks. So I invest in these tech stocks, Amazon and Apple, and I just keep parking my money in there, and that's my strategy. I've made so much money, I'm sticking to it. And they have just this very narrow-minded view of what will happen. Technology is the future, therefore I can put money into this and I don't have to worry. That's a lot of what I see from the retail side. And then on the institutional side, you see a lot of basically just going with the flow, and everybody sort of moves together, and they believe what the Federal Reserve says at any moment, and sort of there's a lot of this confirmation bias, and there's a lot of problems as far as I'm concerned in this way. But in terms of investment strategies, what do you think people should be paying attention to? What do you think they should be looking out for?
Yeah, no. So this is really probably the most important question for most viewers, right? It's like, all right, so what do you do about all this, right? Okay, so you're hitting on a couple of points which resonate quite strongly with me in terms of a lot of content I put out on at Lee Lagerport, and even in terms of framing it for the mutual fund ETF I run. So first of all, diversification is not 500 stocks. Diversification is not 5 stocks. Diversification isn't junk debt. Diversification is exposure to multiple areas that react off of different futures. Okay. We don't know which future hits. So you want to have as much exposure to as many possible future scenarios as possible, because the range of outcomes is incredibly wide. We just talked about inflation, deflation. I personally think deflation is probably the likely path. What if I'm wrong? Very possible. So what do you do about that? Well, you want to have some exposure to disinflationary sensitive areas like treasuries, which is not a popular opinion. You also want to have maybe exposure then to more hyperinflationary environments, which might be gold, which tends to do well when inflation's over 5% persistently. Weighting it is always the tricky part, right? But my point is that a true robust portfolio, or something that is as close to anti-fragile as possible, is one where you don't have this concentration risk in the same factor, which for most people is just beta. It's just the equity market, right? Now, the other part of this is I think you have to kind of think in terms of diversification, not just through asset class, but also strategy. So now I'm talking a little bit up my own book here, but you've got this tremendous movement towards passive that's happened for a number of years, and it's worked. Well, passive needs active and active needs passive as far as portfolio management, right? Why? Because if active is ultimately about managing downside risk and trying to take advantage of anomalies in the marketplace, the anomalies can only exist if everybody is in passive and nobody's looking for the anomalies, right? So my argument would be that, and this is what I do with the ATAC rotation mutual fund, as well as the RORO ETF, which uses that lumber to gold signal for risk on, risk off. In my case, I'm trying to take advantage of a very specific anomaly that certain areas of the marketplace, utilities, treasuries, lumber to gold, tend to warn in advance of risk off periods. If I happen to get it right, like I did in the mutual fund last year, being up 72%, well, now that's a real diversifier in a world where everyone was afraid of what COVID would do to risk assets. Obviously, we ended up being okay with hindsight, but that's with hindsight. So you've got to have as much diversification to different areas of the marketplace. And by the way, that also means areas like Bitcoin, which, some people will see my Twitter feed and think I'm anti-Bitcoin. I'm not anti-Bitcoin. I'm anti some of the reasons that people use for Bitcoin, which I think are nonsensical. Again, nobody knows the future. Have as much exposure to as many scenarios, diversify. And by the way, one final point, the best way to know if you're diversified is if you look at your statement and there's an investment there that you really, really want to sell because it's not performing well. Diversification by definition means you have to have parts of your portfolio that you hate, because you're going to hate that which is not moving in the same way as all of your winners. But diversification means you should have losers, because it's about the sequence of returns and the interaction of those investments.
That reminds me of sort of never lose money, that rule of investing, where over a long period of time you can't look at it on such a short-term scale, because you're never going to get that big picture. A lot of the investors are doing so, they've been investing for a few years or since 2009, and they really only know one thing, and that is just to buy the same thing all the time and put all their money into it, because that's how you get the highest appreciation. If you would have bought this or that, maybe you wouldn't have got it. But of course, you got to understand that This is your whole portfolio that you're talking about here. It's not, $50 or something. This is a whole portfolio. It's got to go over decades. It has to be able to last a long period of time. And that's why you got to implement these strategies that are really, in my opinion, really intelligent, instead of what we see, catching the next hot thing. And it just doesn't work long term. That's the point.
Yeah, and to the
Yeah.
point, right? I mean, I think a lot of people are increasingly short term in the way that they think. I think all of these zero cost, zero commission brokerage firms are in many ways the worst thing for retail investors. So when I was presenting on the road at CFA chapters, um, talking about these award winning papers that I'm known for, which the Lumber to Gold one is documented in as a signal. I used to always say to the audience that if you're an investor, you should probably go with the highest cost online broker as far as trading goes. And I'd always get people laughing, like, what the hell are you talking about? Why would I want a broker that's going to charge me a lot of money? Well, because there's a lot of studies that show that the number one reason why people underperform buy and hold is over trading. So there's an incentive when you have these types of firms that have zero costs, aside from sort of the ethics about selling, the data on the trading side. There's this sort of perverse incentive by having zero cost trading to overtrade, because all right, if you're wrong, you can always get back in. Right. That's different from a systematic approach, right? So in my case, the funds that I run are highly active, but it's a rules based approach based on an anomaly. Most people are not trading that way, right? So it's a very underappreciated aspect about market dynamics. I think the other part, real quick, about that is, look, I always say whenever somebody says, "Oh, look at my signal, look at my strategy, look at how it caught this huge move," I say, "Okay, great. What's your N? What's your sample size with which you're doing a back test or any kind of strategy?" And the truth is, we never really know how much data you need to know if your asset or your strategy. You never really know how large that frequency of that N should be, that interval. And I would just ask the audience to think for a second. You know, buy and hold for the long term. Okay, buy and hold is a back test, plain and simple. It's a back test with one trade, but it's a back test. We don't know if the last century or so, century plus, of this experience with investing in the stock market and capitalism, we don't know if that's going to repeat the next century. In other words, we don't know if the last 100+ years is a large enough sample size to really have an understanding of how these things work. Maybe that was the anomaly, if you kind of think very, very long term. All right. So all that means from an implementation standpoint is you got to be humble, you got to diversify into different areas of the investable universe, and always be skeptical of the here and now, because it's tomorrow what matters.
That's really interesting stuff. I know that my subscribers will definitely be appreciating this. If there's the best way, sort of, to find out about you, to find out about your information and everything that you do, what would be the best way for them to get in touch?
Yeah, I appreciate that. So on leadlagreport.com, that's the premium research service. The funds are the ATAC funds, atacfunds.com, risk on, risk off, tickers RORO, RORO. And then, of course, on Twitter at Lead Lag Report. I have north of 350,000 Twitter followers. Some of them are a little mean, but that's okay. But I try to be very accessible. I find that relationship building still matters in a world of zeros and ones, and I do my best to try to engage with everybody that's engaging with me.
Excellent. I would highly recommend people definitely check Michael out. A lot of good information there, even just from the Twitter feed, and then you can go in deeper from that point. I think that everybody should be taking his words very, let's say, take them in and understand how important they are, because if you're watching CNBC and Bloomberg and so on, you're going to get such a small piece of the puzzle, and there's so much more out there that we need to be focusing on. And he's mentioned just a few points of how much there really is. So definitely, once again, I appreciate you coming on. Thank you very much. For myself and the subscribers, thank you. And hopefully in maybe 6 months, a year from now, we can do a follow-up.
Yeah, no, and David, good work on your end. I think you're doing important work by just providing a different perspective. I mean, at the end of the day, to your point, we have to get out of these echo chambers. We have to get out of this confirmation bias, and it's always good to think about the other side of the picture.
Thank you very much for coming on, and take care.
Thank you. Cheers.